Welcome to the Hedgeye studio in Stamford, Connecticut. I'm Daryl Jones, the Director of Research at Hedgeye, and I'm joined by my colleague Jay Van Sciver, who runs our Industrials Research Group. Today we're talking about defense stocks. The first question I have for Jay about defense stocks is, what is the government shutdown? How will it impact defense stocks?
So we've been much less focused on the shutdown than much of the media has. We're instead looking forward to the fiscal 14 budget and the impact that that will have on defense contractors. And we think that defense contractors are one of the most exposed groups to this tighter budget environment.
So within the next budget, is there anything in particular you're looking at?
So when the budget shrinks and that budget is passed, DoD will be forced to make what we call program-specific actions. They'll be either keep, shrink, stretch, or cancel given programs. When that happens, it has significant impacts on individual defense contractors.
How does that actually play out into the accounting of these companies?
So one aspect of defense contract accounting is that they tend to be long-term contracts, accounted for on a percentage of completion basis that tends to put revenue and profits in different accounting periods based on a series of assumptions. When contractors recognized that defense spending was going to become more difficult, they started reducing costs, and that had the effect of expanding margins. They didn't have any program-specific guidance, but they had lower costs, margins expanded, and that tended to result in what's called a cumulative catch-up adjustment. So it brought earnings they would have reported had they had those higher margins in previous periods into a lump of recognized earnings in the current one. And if you look at Northrop, Lockheed, or Raytheon, you'll find that a significant portion of their current reported earnings are from these cumulative catch-up adjustments, EACs, which are associated with these cost cuts ahead of program-specific actions.
So what kind of magnitude are we talking about in terms of, I guess, potential cuts or adjustments?
So the reduction to earnings is in fact quite substantial. So if you look at the potential reduction to earnings, we don't exactly know how it will play out, but for example, over 40% of Lockheed's earnings are from what they call EACs, these cumulative catch-up adjustments. Northrop is about a third, Raytheon is a bit over 20% in the second quarter. So you're looking at very significant contributions to earnings from these cost cuts ahead of program-specific actions. However, when you get a program-specific action, when they actually say, we're going to have fewer units, we're going to cancel this program, those cumulative catch-up adjustments may be at risk. A good portion of those earnings may in fact disappear.
So I guess just to summarize, we're very cautious on defense stocks. They're trading at 52-week highs, and we think they're going to be defense-focused cuts in the 2014 budget. The impact of that will be to cut some of the current contracts that are out there, and we'll see some key earnings of a number of the companies potentially get hit in the future. Thanks for joining us in our discussion of defense stocks. If you have any additional questions, feel free to reach out to me on Twitter at HedgeyeDJ or Jay at Hedgeye Industrials, or email our sales team at sales@hedgeye.com. Thanks.